Well, I think the real two risks that I think we would focus on would be the uncertainty about politics. Pretty much globally, there are going to be changes in political policy. In the first quarter, it's all about America. It's all about Trump. It's all about the first 100 days. In the second quarter, it will all be about France and the elections and whether we see further Brexit-type shocks inside the European system. And then I think in the second half of the year, it is all going to be about the expectations of the new government in China, the new policies and the new prioritizations. So I think the markets will have some ebb and flow simply because of the natural events that we will see in the political cycle. And as you are well aware, we're all going to be watching Twitter in 2017. I think the second risk, but also the second opportunity, is the oil markets. We think there is still very solid global demand for oil, and because of the collapse in the oil price, there is actually very low levels of investment in oil. However, car sales in Asia and in America are at record highs, and therefore the underlying demand into 2017 for oil will remain very high. Therefore, we tend to feel that a rising oil price could be good for the oil sector, which has been very unloved. So we have to watch that dynamically to understand how that may affect the markets as we go forwards. I think when it comes to inflation, the first half of this year is easy. It's all about oil. All about oil. Asia, Europe, America, inflation's going up because oil is going up. In the second half of this year, it's all going to be about wages. And if we see continued wage growth in the US, you're going to see rising inflation in the US, which will therefore possibly create more interest rates in the US, which will strengthen the dollar. The only other area where we're going to see inflation is where currencies have weakened substantially. The three currencies that have weakened the most recently have been the yen, the British pound, and the euro. So therefore, we would expect over time to see some imported inflation because of the weakness of their currencies. Negative interest rates, quantitative easing have not really worked. So we're going to see more fiscal stimulus. That will boost underlying economic growth, provided the fiscal stimulus is either spent by you and me as taxpayers, or it is invested in the economy in a wise and productive way. We have not started to pay down our debt from the financial crisis, and therefore, if we keep borrowing from the future, at some point we reach a payback situation. So Allianz Global Investors' key investment hypothesis remains that interest rates will remain lower for longer, that global economic growth will remain relatively dull, i.e. not back to where we were in 06 or 05, and that you therefore need to have a recognition that investment returns are likely to remain single digit, not double digit. We think allowing us to go global with that allows us to find the best asset classes and the best opportunities for our clients. So we think it's a very safe and rational way of moving from cash and fixed income investments towards multi-asset and ultimately global equity return, so that we end up blending the longer term returns but more volatile returns from equity markets with the income returns from fixed income markets, which are also less volatile. The client ends up with a better risk and return for the amount of risk they're prepared to tolerate.